Okay, Tyler, we're going to talk about Canoo again. And this is one that we generally try to avoid unless there's real material things happening that we think are really important that investors need to understand. Right now, on January 9th, stocks down 16% after an SEC filing. It's a proxy, their preliminary proxy statement, I think. And some things that they're proposing in there clearly have some shareholders concerned, adding to the litany of reasons to be concerned about the company. You ready to go through this and also a couple of other pieces of news the company has dropped this week?
It's going to be it's the tale of two things. What's said in the press release and what's said in the SEC filings. I feel like it's a recurring theme with a lot of videos that you and I do.
Yeah, I think so. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. I've said this before on videos we've done for Canoo. If you're a diehard Canoo fan, if you're a Canoo stan, however you want to describe yourself, probably not talking to you here. This is probably not going to change your mind. But for anybody out there that's looking to make money in EVs, you think this is a really cool company and there's some great opportunity here, the financial reality is completely different. And we want to be abundantly clear about the massive risk that investors who buy shares of this company are getting into right now. Tyler, I want to do this in backwards order. I want to talk about the press release first. And this came out on January 8th. At the same time, there was an SEC filing that they made, their preliminary proxy statement, right?
Yes.
You can guess which one sounds really good, and you can guess which is maybe concerning for investors. The press release first. I'm going to pull it up here. Canoo acquires manufacturing assets to increase vehicle assembly capacity. This is positive for a company that's trying to make vehicles. We know this is an incredibly capital constrained business right now. They've had to pull out a lot of stops just to raise money over the past year or so. And they're saying that they were able to acquire some robotics and some control processing equipment to build their vehicle cabins at an 80% discount to estimated value. Tyler, what are your thoughts here?
I think it's the first time I've ever heard of a company giving a press release to say that they went to a scrapyard and picked up parts off the chief. And this is,
Right.
it's the only way I know how to explain it. I've never seen something like this before. It really seems like a trying to put something out there to sound good. Sure, buy them at deep value. Great. It's got to grow sales. And that's been one of its problems. And funding has been a huge thing. So yeah, we could you can spin this all the ways you want. This just kind of sounds like we're papering over some of the deeper issues at the company here.
That's a fair way to think about it. And again, I want to say this publicly too, because inevitably somebody is going to accuse us of being short the stock. I'm not short the stock. Tyler, are you short the stock?
I have no position long or short.
Same. I have no financial interest in this stock. We are not being compensated by anybody to say negative things about this company. We're not being compensated to say positive things about this company. We're giving our objective analysis. I think I'm going to state that abundantly clearly. This stock at recent prices trades for 21 cents a share. Let's talk about the preliminary proxy statement, because this is, I think, where we get into some of the material stuff that investors need to be super aware of. SEC filing, you can go to the investor relations page on Canoo's website. You can also go to SEC Edgar. I'm going to pull this one up too. There's two sections out here that we want to talk about.
So we got two big things that they're more or less voting on. The third one is basically, let's table everything else. So let's focus on the two. The first one is a reverse stock split. Basically, what happens is when a company's stock price gets too low, it falls out of the listing requirements for the exchange that they work on. And in this case, the NASDAQ typically requires at least a stock price above $1 to qualify to be traded on the NASDAQ. So one reason that you can do that is by doing a reverse split, which basically means instead of splitting your stock from one share to two shares, you go the opposite direction. So say if they were to do a 10-to-1 reverse stock split, for every 10 shares of the company that you own, that would be reduced down to one. As of right now, shares are trading for 21 cents. So if they were to do a reverse 10-to-1 stock split, your 10 shares worth 21 cents would now be worth one share worth
$2.10. So in a vacuum, and I think that's really important to talk about this too, is that in a vacuum, the percentage that you own of the business stays the same because the total number of shares changes along with your number of shares, and the economic value of your interest remains unchanged. But obviously, when companies are doing this, it's because there's problems. In this case, because your stock has fallen so much, it's below what NASDAQ, the exchange that you trade on, is willing to accept for a stock to remain on the exchange. So they're having to do it because they don't have any choice.
I'll also mention too, and this is not a prediction of what exactly is going to happen, but typically what happens when a company does do reverse stock splits, it's also done in a way so that they can issue more stock in the future. Because if
Right.
I issue stock at 21 cents a share and I have to do hundreds of millions of them, it's really hard for a banker who's running my secondary share issuance to actually fill that order. So let's reverse stock split 40, 50 to 1. And all of a sudden that stock is worth $10, something like that. And you don't have to issue as many. It's a little bit easier for your book runners to actually fill your secondary offerings.
They actually talk about that. And I think it's more than just for secondary. The idea is, and a lot of institutional investors, they don't touch penny stocks, right? They're not going to touch them at all, even if it's potentially a legitimate business, which Canoo's trying to become like a real commercial entity. They just don't have the capital to actually build vehicles and sell them at this point. That's the big holding point. They're not a fraudulent business like a lot of penny stocks. They're an actual business. They want their stock price to be more attractive to institutional investors. The idea is that could prop up a share price that would be higher and potentially allow for the ability to do secondary offerings, right? So they're all very much tied together. But again, this is the one thing, right? And in a way, the reverse split is a neutral event that's occurring because of all of the bad stuff that's happened with the business over the past couple of years. Their struggles to come to market with a product, their struggles to raise capital, to effectively allocate that capital to build out manufacturing capacity or to get their partnerships with third parties up and running quickly enough to generate revenue to replace the cash burn of the cash that they previously had raised. Maybe it can help them resolve it. But this is the one that's a little concerning. The second one, the proposal for CEO equity awards.
They have issued, I guess I'll use a nice word. We'll call it an enhanced CEO pay program. Basically, what is looking to do is drastically increase the amount of shares that CEO Tony Aquia can actually receive through performance and restricted stock shares. Basically, if you between the two of them, I think it's 39 million in performance, 78 million in restricted, which basically means time involved in the company. So you combine those together, it's about 118 million shares in the company.
And that's at the current share count.
That's at the current share count. Yes. As
right. So
of
these
today,
these would adjust based on whatever the shareholders vote to pass in terms of the reverse. Yep.
So as of today, there's about implied shares outstanding, which means all current outstanding stock options. There's about 877 million shares. Of those, if we were to add this 118 million, we're basically saying that the CEO can earn 13%. They'll add 13% more to the total share count, basically more or less giving him 13% of the company if he meets certain standards. Some of them are based on revenue. Some of them are based on basically increasing its stock price, which I've got to assume are probably going to be a result of revenue and showing some sort of business success. And look, what I think we could all say that yes, incentives matter. And if you were to put a really big number in front of somebody and say, go do this, they will move heaven and earth to do it. People want bonus checks and they want the biggest one they can get, and they will do everything they can to get it. But then there's also the point of the shareholders. Is it reasonable? Is it reasonable that we're going to give the CEO of the company 13% of it just to more or less turn it around from becoming a fledgling company? Viewed in the best way, if he actually does turn this around and people who are investors today at 21 cents a share, and he can double or triple the stock price, which are some of the targets that are actually built into this package, maybe you could say that's worth it. But look, I'm a stickler for executive compensation. Jason will nod his head in silence while I say this, but there are good incentives and then there's egregious incentives, and 13% of a business to keep it from going under seems a bit egregious, especially for somebody who already owns a decent chunk of the stock already. So I think when you see something like that, and look, shares are down 15% today. After that, I'm going to guess the market didn't like the fact that they want to hand over that much to the CEO either.
I think there's a couple ways to think about it. And if you're looking at a company that's an established going interest that doesn't have a going concern notice like Canoo has, which is they're in their filing where they're disclosing to their primary regulator that they do not have the cash flows and or capital, or combination of them, to survive the next year, right? They're basically saying we're running out of money. That's the case with Canoo. So I think if it's a company that's not in that case and it's a stable, mature, fine business, this would be the height of the board of directors acting well outside of their responsibility as fiduciaries to existing shareholders to give out this kind of a compensation plan. But I will say that for a company like Canoo that is in such dire straits that they're issuing press releases bragging that they bought used manufacturing equipment at an 80% discount of estimated value, that it's completely reasonable. Because if he does the things that will pay him 100% of his bonus in equity, shareholders of this company today will make money. They'll make a lot of it, and they'll be super happy because the guy took a company that was on the verge of going out of business because they don't have the resources to buy new equipment to manufacture their vehicles. Then it could be a wild success, and it will have been worth it. Is it the best approach? I think it's, to a certain extent, maybe it's about the only approach that's viable, is to be willing to create this sort of level of incentive that you could take a company from that's on the verge of catastrophic failure to being a financial success. You give somebody that big of a percentage of the equity on top of what they already have. Does that make this a business that you want to invest in? For the company to be in that shape, that this is the compensation plan they're willing to put for a turnaround, I think you have to stay away. I think investing in a company with this level of risk is a mistake.